The RBA has now hiked rates by another 25 basis points, taking the official cash rate to 2.85%. This is one of the steepest rate hike trajectories we've seen for quite some time. Now, the RBA is clearly trying to get on top of inflation. It was above 7% in the last reading. But if we're looking globally, inflation has been running away. For example, in the EU, inflation just came in at 10.7%. In the US, it was 8.2%. Inflation is high almost everywhere, hence why the RBA needs to move. Indeed, the 25 basis point hike is relatively small compared to other locations. The European Central Bank hiked by 75 basis points recently. Nevertheless, the 25 basis point hike is not great news if you're in the property market, either buying property or currently owning property. This additional 25 basis points means you'll be spending a few $100s more on a variable rate mortgage each month. Every few $100 adds up, and with all of these rate hikes we're seeing, that all of a sudden becomes another $1,000 each month on a mortgage, if you have $1 million mortgage, that is. And $1 million mortgage is not uncommon for many Sydney prices. Furthermore, there are future rate hikes that might be occurring, and this is factored into what banks are setting as their current fixed rates. If you're currently on a fixed rate, you now potentially have the prospect of a mortgage rate cliff coming up. Indeed, quite a large number of mortgage holders are predicted to have their mortgages, their fixed rate component, end by the end of 2022. And indeed, many property owners are going to see their fixed rates end in 2023. They're going to see potentially a doubling in the interest rate that they are facing. If you're going out and trying to buy a property, of course, this might look like it is good news on the one hand. Maybe property prices might fall. But on the other hand, you're now paying a higher interest rate. Banks are going to be assessing you on whether you can pay back a 5% plus a margin interest rate as opposed to a 2% plus a margin interest rate. That is, they're going to assess you on more stringent guidelines. And wages simply haven't kept up as much. And therefore, your borrowing power might have all of a sudden gone down. Now, notably, the RBA has recently come out and predicted their base case that property prices will go down by around 11%. This notably is very aligned with analysis by Coolabah Capital and Christopher Joy at Coolabah Capital, who suggests that properties could go down 15 to 25 basis points on the back of the RBA's interest rate increases. i.e., if you bought at the peak, you could easily end up underwater on your mortgage. Now, this then begs the question of what do you do if you're in the market or if you hold property? Well, if you currently hold property, you need to really assess, how is this increase in interest rates going to affect me? Can I weather the storm? And am I going to be facing a mortgage rate cliff? That is, if you genuinely are not going to be able to afford your mortgage in 2023, you really want to be looking at your options earlier rather than later. That is, do you sell now, even though it might not be the peak prices? It might be better than taking a bigger hit next year potentially, or doing a distressed sale. So if you really can't afford your property, consider whether you need to sell and consider what's going to happen to future interest rates. If you're currently in the market, you can be a little bit more cautious. You can perhaps wait it out. Now, while interest rates might increase, the trajectory of those hikes might slow down. So the future impact on your borrowing capacity might not be as large. So if you can borrow now, you can borrow in the future. And as a result, you can probably wait for your ideal property. If you are potentially really interested in a property, if it's one that is either ticking all of the boxes and is a unique property, or fits some other purpose, you could potentially go ahead with that still. Now, you might still take a little bit of a loss, because we haven't seen property prices go down that 11%. They've potentially declined 5%, and depending on the capital city, maybe a little bit more than that. But we haven't gone down as much as the RBA is predicting. So be prepared to potentially take a little bit of a loss. But if that property is rare or unique or doesn't come up very often, that might be a cost you're willing to bear. So consider strategically what you're doing with the properties you are buying. Now, in terms of what this means for property prices going forward, well, each incremental interest rate increase is not brilliant news for property prices. It slightly takes the wind out of the demand for those properties and reduces how much people can afford to pay for the property. So every interest rate increase is obviously negative news. Some of this is already priced into what properties are getting, i.e. when people go out and they borrow to buy a house, they already are pricing in what is the prospect of a future rate hike. So there's a limit to how much each incremental hike now is going to affect these prices. The only real bright spot is supply remains constrained. All the time interest rates remain so high, people aren't going to go out and build new housing stock. As a result, for in-demand areas, there's only so many properties, and the seller still has a degree of market power. i.e., even though the federal government has signalled the desire to build more affordable housing, oftentimes that won't be in the really desirable locations, and that will take some time to come online. In terms of what this means for renters, well, renters clearly aren't necessarily going to benefit from this. You might see housing prices go down. However, the fact that interest rates have gone up and new housing stock isn't being brought to market because people can't afford to build it, that fact means there's still going to be pressure on rents. And the fact that people can't afford to go out and buy a house now, potentially, because of these higher interest rates, means maybe people want to rent for a little bit longer, which again can put some price pressure on rentals. Nevertheless, that's a bit of an overview about what the RBA decided with its 25 basis point rate hike. If you have any thoughts about what the RBA decided to do here, whether the RBA was wrong, whether they should have gone harder, or potentially softer, let me know that in the comments below. And otherwise, hopefully I do see you for future videos as well.